This is Distillation Dance number 5. This is going to be a fool's understanding of how the stock market works. I'm not going to cover all of the in-depth details of the basis of the stock market, but I will cover enough such that understanding how the market operates from at least the most basic of formats will be possible. And hopefully this is easy enough to understand that everybody is able to think as they plan how to deal with the choices they make with their money. So let's start off with what is a stock? Simply put, you have companies or corporations, as we like to call them, and these companies can raise money in several ways. The first way of raising money, which isn't really raising money, is to go to the bank and get a loan. The second way is to offer what they call corporate bonds. Now, the bond meaning promise, bonds are essentially promissory notes wherein, let's say that I want to borrow, when I say borrow, I mean I'm going to sell you a bond for $1,000, right? And the agreement is that, let's say, for 5 years, that bond, I expect my company to grow. So for that bond, at the end of those 5 years, I will pay you, let's say 5% per year for a total of 25% on the bond for the use of your money for those 5 years. If my company is successful and grows, leaps and bounds, goes up in value, if I go from having 100 customers to 1,000 customers, paying back that 25% shouldn't be a problem. I mean, it's over 5 years. Then you have the other vehicle that companies can use to gain funding, rather. And that is to offer stock. Now, what stock is, as they say, a share or a part ownership in the company. So I will sell you a part of the ownership in this company in exchange for the money that I will need to perform my operations or make acquisitions or do whatever I want to do. And thus the stock market and the bond market. So let's say I open company A today, right? And company A being, a company that I believe to be successful in the long term, I now want to go ahead and offer stock in this company. I either have the option to offer the stock in this company, the part ownership of this company, to private investors. And let's say that there are 1,000 shares of this company. Let's say I choose to sell them 10% of my company. And I agree with those private investors to purchase that stock at, let's say, $1,000 a share. For $100,000, they're going to make a $100,000 investment in my company. But as a result, they're going to own 10% of my company. And that 10% will, determine whether or not, well, it has a voting say very often in what the company does or the decisions the company makes. Let's say my company sells lemonade, right? So I'm now a lemonade sales company, and I have determined that it would be in my best interest to take this company nationwide. And as I take this company nationwide, I need to get more money to fund my nationwide expansion. In order for me to do that, I'm going to need more investors. I'm going to need more capital. I'm going to need more money. I'm going to need more buckets. So I take this need for capital, and I go to the banking system as a whole, or the stock exchange as they like to call it, because the people that run the stock exchange are, generally speaking, the Wall Street banks. Wall Street being a term for investment banks, and generally speaking, the Federal Reserve banks. See the bucket maker from the previous parable. I go to these banks now and I tell them that I want to sell my company to the public. And when I say sell my company to the public, it means I want to raise money. So now there's going to be a process for me to take this company public. First of all, they're going to look through my company financials. They're going to see whether or not my company is profitable, whether it's worth them even putting their name to back the investment, or whether it's worth them buying a certain percentage of the company and going forward. But this is even before I make it to the market. So they go ahead, they do this research, they see that my idea seems to be a great idea. Hey, not too many people are selling lemonade nationwide, and everybody wants lemonade on a hot summer day or on a cool day. Lemonade is a drink of choice, so we're gonna go ahead and look at the possibility of funding this guy, or allowing this guy to gather funding. So I go to a bank, they look at my lemonade company, they see I have a certain amount of assets in my lemonade company. They perform what's called a valuation on my company. That's right, the bucket maker gets to tell me what my company is worth. And they give me a take it or leave it deal, basically, where they say, well, your company has X amount of factories for lemonade. We project that you're going to sell, 1 million bottles of lemonade a year. Of these $1 million of lemonade that you sell per year, you're going to make $1 million, but your costs are going to be, let's say, 50 cents a lemonade. So now you make $500,000 worth of profit a year. And because of that $500,000 worth of profit you make a year, we can see the company expanding in a certain point in time, and we will value your company at, let's say, $10 a share. And in this process in which they underwrite the company, they go ahead and say, okay, you can't sell these shares to the market yourself. So what we're going to do is we're going to take care of the sales of these shares to the market for you. And the valuation on that company is going to generally be the price that we say. So at these $10 a share, and you're going to issue, let's say, 1 million shares, right? So you'll be able to raise $10 million through us taking your company to the market. And what they tend to do after underwriting the deal is they tend to sell those shares into the market. They'll give me a certain amount of money, and then they will sell the shares into the market at said price. And then the shares will now go on the exchange. So I've already collected all the money I'm going to collect from my company, this $10 million. Now somebody sees this lemonade business on the stock market and they go, hey, that sounds like a good stock. That could be a pretty good investment. So what they do is these ownership shares, at this point, these ownership shares are out there for whoever buys them. I've already collected the money from the initial offering of these shares, which means that $10 million is all I get from the stock market for right now. If tomorrow that stock goes up to $50 a share because somebody believes that my company will be worth $50 in the future, and they spend all that money buying up all those shares and pushing the price up, if they go ahead and do that, I still only have that $10 million. If my stock price after this drops to $1 a share because people look at my lemonade company and think that's a stupid idea. Why would anyone have a lemonade company in today's world? Lemonade is so outdated. And you have people that sell it and nobody wants to buy it. or so would say the laws of supply and demand, but we're going to get into that a little bit later. Then my stock price is going to drop. I've already collected my $10 million. I can continue running my company with that $10 million. But, this is a big but, the share price of the company has now dropped. Now, what this share price does is the share price is essentially the quote unquote market's valuation of my company. Meaning that if I have a million shares out there and my shares are still worth $10 because people believe my company's worth $10, I have that that's what my shares are worth at that point. If people believe my company is my I have a million shares out of my company and they believe my company is going to explode in value and they buy the shares for $50, that's what those shares are worth. This affects the what they call the market valuation of the company, but it does not affect the underlying fundamental value of the company. So if I've only got two factories and people believe my company's worth $50 a share, I've still only got two factories. That if tomorrow I went bankrupt, I would have to sell those factories. I'd probably only get, $3 million out of the factories, but it's what they believe it's worth. Now, well, that would be in the case of proper supply and demand. And you have the stock exchange, very often the New York Stock Exchange, the NASDAQ. And you've also got the brokers. And the job of a broker is to allow people to buy or sell these stocks on the market. Essentially, the broker used to be the guy standing in the New York Stock Exchange saying, I want to buy, I want to buy, I want to buy. Or I want to sell, I want to sell, I want to sell. And they would buy and sell those shares. And then they would say that you would tell them, hey, I want to own a certain portion of this company. And they would act as the middleman for a fee to buy and sell those shares for you, because you're not going to go to the New York Stock Exchange and stand down there and wait to buy your shares. You're going to do it remotely, whether it be via phone or via online broker or whatever. So not only do you have the brokers, but you also have what's called market makers. And market makers are the middlemen of middlemen. The market makers will buy up a certain amount of shares. So let's say your public offering goes well. The market maker will buy up a certain amount of shares and provide what they call liquidity. Now, liquidity means that they have a certain amount of shares that they have in their possession, and they can actually buy and sell these shares from their possession and make it possible for brokers to fill their orders really quickly, because otherwise you would have a guy buying your shares at $10 a share and somebody saying, hey, well, I want to sell at $8 a share. Well, the guy who's buying at $10 will take that $8 price because it's lower than what he wants, right? But let's say there's somebody that wants to buy at $6 a share. The person's only selling at $8. Well, there's no give and take in that, because as long as that order says $6 and as long as that order says $8, there is no movement on either of those prices and nobody sells or buys. So what they refer to as liquidity is the ability to meet somewhere in the middle and, moving the price in such a way that they can buy and sell between people. So if there's somebody who ordered 1,000 shares, well, one broker may not be selling 1,000 shares at that point, but the market maker has those 1,000 shares, and they can sell those shares to the broker And the other broker who's selling 100 shares, the market maker will buy those and put those back in their stockpile and proceed to, as they say, make the markets. So they're the middlemen of middlemen, and how they operate is they make money off the fractions of a cent difference in overall transactions. So let's say let's say it's 1 cent. Let's make it easy. Let's say it's 1 cent that they make on a transaction. So one guy's buying at $10.01 and the other guy is selling at $10. They will take the order at $10.01 and match it to the order at $10 such that they can bridge the gap in the value, pocketing the profit in between. And if there are a million, that's right, if there are a million transactions that occur in this way, or a million shares that are traded in this way with the market maker as the middleman, they will now make, what's a million times a penny? It's 10,000. That's not bad. But think about the millions and billions of shares that are traded every single day. And that is how your market maker makes their money. Of course, you've always got to pay your middlemen. And your market maker also has other ways to make money by way of, selling the option to buy and sell from their stockpile, or shorting and meeting orders and then filling those orders later. So they sell out from their stockpile and then they fill those orders later when the price has gone down and they get the value there as well. You also have what's called institutions. We know them as hedge funds. We know them as capital or acquisition groups. You name it. BlackRock, Vanguard. These guys who, as some of the old folks used to say, have more money than God. And what these guys do is interesting, because these hedge funds, what they do is they take the stock market as a whole, and their number one goal is profit. These hedge funds aggregate money from different people. Let's say Bill Gates, let's say Warren Buffett, let's say, you're billionaires and millionaires, and they say, hey, I'm going to give you $1 million. I want a 5 to 10% return. The hedge fund says, yeah, let's do that. But when you get 1,000 people with $1 million, you now have $1 billion. That $1 billion is capable of buying and selling large portions of stock and even influencing prices. For example, if someone spent $1 million in Apple stock in one go, you would expect the price to go up based on the laws of supply and demand. Law in quotation marks. So these hedge funds, what they do is they go ahead and they make these trades and they buy into things and they make investments, and their goal is to get a certain profit after a certain amount of time. These hedge funds have a very long game because they have a lot of money that they can sit on and they can wait for something to quote unquote appreciate in value. However, some of these hedge funds, these institutions, also have an advantage over your average Joe Blow investor. Your Joe Blow investor will go ahead and say, buy 100 shares of Apple at this price. Your hedge fund will look at buying 1 million shares of Apple at a certain price. But you know what? Let's say Apple's $100, and I really don't want to spend $100 on Apple because I'm buying 1 million shares. So what I'm going to do now is to affect the price of Apple stock till it's where I want it to be. This is what we call stock manipulation, which is what they say is illegal, but once again, laws are only applicable when enforced by violence, and when you look at somebody who has billions of dollars and you hit them with a $10,000 fine, it's like a $3 speeding ticket. You might not even have enough change for it. Can you just take a 20 and get off my back? So let's go ahead. follow these hedge funds. So the hedge fund is now going to look at, let's say, this Apple stock at $100 and say they want this stock at $90. There are multiple ways they can get this stock to $90. First of all, being a multi-billion dollar company or multi-million dollar company, they have computers that literally trade hundreds to thousands of transactions in a second. That's right. Buy and sell. One person buys at $10, the other person 1001, the other person buys at $10 or sells at $10. Well, if all these transactions occur very quickly, and then they've got a direct hard line, very many of them, into the New York Stock Exchange or the NASDAQ, whichever stock exchange is at that point. They use their computers to trade the price back and forth in such a way that they can affect the price. Because the price of any given good is based on quote unquote supply and demand, right? If everybody is going to buy and or sell, let's say they look at your company A, your lemonade company, and they believe that your stock is worth $100 a share. If they keep buying your stock at $35 a share, they're going to drive the price of your stock up towards $35 a share. Or if they keep buying at increasing increments. So let's say you start at $10 and then the next price is $10.02 and then the next price is $10.04 and they keep buying all the way up to $35. What this does is people are looking at the price going up and they're willing to sell at those higher prices. People are looking at those prices going up and they're willing to buy at higher prices. So what they're going to do is they're going to keep doing this over and over and over again. And these prices will eventually reach the goal that they want it to do, whether it be 100 shares at a time, buying and selling, or one share at a time, or 500 or 1,000 shares at a time. But remember, these people are capable of doing hundreds and thousands of transactions per second. It's not like you who has to go into your brokerage and potentially type in the stock name, type in whether or not you want to buy or sell, and how many you want to buy or sell at what limit price. These things are literally computers, machines knocking these price movements out day in and day out, hundreds of times a second. So let's say they want the price at the price for Apple is $100 and they want the price at $90. They can move the price down themselves. Yes, it's going to cost them money buying and selling, and there's going to be a certain degree of loss for them, right? Because they're going to move as they're buying and selling. There's some money changing hands, and the price is going a certain way. But they can also do things because these hedge funds are multi-million, billion-dollar institutions, right? They can also send out an article saying that Apple's going to have a shortage because they've got a buddy in some news media outlet, whether it be CNN, The Motley Fool, something or the other. They put out that news that Apple is going to have a shortage, which causes Apple's price to drop because people think that shortage is going to affect the productivity of the company. They can control the information, they can control the price of these things to the point that the original law of supply and demand doesn't really apply. It doesn't matter if you as an individual think that Apple is worth $105 or you want to sell your Apple at $105. What happens is that they want to buy Apple at $90 and they're going to, by hook or crook, move that price to that $90 mark. This is what we would call an accumulation scheme, meaning that they are gathering shares as low as possible. With this accumulation scheme, this occurs and these institutions buy low and then they push the price up into what is called a distribution scheme. They're going to buy low and sell high. So this institution, let's say they're going to buy that million shares of Apple at $90. Then they're going to go ahead and sell those million shares of Apple up at $105, for example, right? So what they're going to do, the same way they push that price down, now they're going to buy in certain increments and move that price up. And now they are selling that Apple at $105. But you, as the retail investor, are looking at that Apple stock and going, wow, Apple's going up, I should buy in. You go ahead and buy Apple at $100 thinking it's going to $110, and at $105 they sell. You now have bought Apple, and because they sold that million shares of Apple, the price has now dropped back down to a lower value. You are now in the red on your Apple shares. That Apple's only worth, let's say, $95 now. And you thought it was going to 110. In this way, they achieve their profit goal, and at the same time, they create a buying market for that sell that they try to do later on. So, in the way of accumulation and distribution, the stock market is constantly moving upwards and downwards, upwards and downwards. There is no individual investor, and I say this excluding people like Warren Buffett and Elon Musk, but generally speaking, there is no individual investor. Well, actually, no, even Warren Buffett can't match up to BlackRock and Vanguard because BlackRock has $10 trillion in assets. Warren Buffett's only worth several billion. No individual investor can match these institutions. Punch for punch. Price move for price move. And as a result, while it is possible for the average person to make money in the stock market, it is also very likely that the average person, by way of information being sold to them, or them being on the wrong side of a trade, it's very possible for the average person to lose money. And the average person does not have the power of supply and demand because, as we go back to the bucket parable, they just don't have enough buckets to move the things that they need to move. Whereas an institution with trillions of dollars can put $1 trillion into pushing the price of a stock up and then sell, take that profit from the unlucky fool who buys it from them at that lower price, at that higher price. Lather, rinse, repeat. So you go ahead and you work your entire life, put your money in a 401k. Your 401k is managed by the hedge fund, right? Hedge funds are going to charge you fees to use your money, and then you go ahead and say, I'm going to invest in the market. Let's say you're going to invest in that Apple stock, and you decide to buy it at $100. Well, that hedge fund that has your 401k, which has your money, is going to use your money against you, run the price up to 105, and you don't sell at 105 because you think it's going to 110, and they push the price back, they sell and push the price back down to 95, and now you are in the red, using your own money against you. What's this? You thought there was a free market? Not so much. But we'll get back to that free market topic on another video. The basis of the stock market is that the bucket maker, the crafty blacksmith, because he controls the flow of money, he decides which companies are even allowed to go public. That's right. Because there's a bank at the end of the day, a bank or an underwriter or some kind of fund that determines that, well, this company, we will underwrite them for going public on the stock exchange in exchange for X amount of shares or X amount of dollars. And based on the valuation of that company can start off with like we used in the example, company A, $10 million, or if they only determine that the shares are worth $1 a piece, only $1 million. And then when that company needs to raise more money, they can either go by way of bonds, which means selling the loans of the company, saying we're going to promise to pay you back more if you just give me money now, or the stock, and they can sell more stock into the market in what's called a dilutive event, right? Because it means that the ownership of the company is spread out more. They can now go ahead and sell those shares at a certain price. But selling those shares at a certain price is determined based on the price in the market. So let's say the price is at $1 a share. Now you got to sell 5 million shares of your company, a larger portion of your company, to get the $5 million you need to keep running. Whereas if your company was worth $50 a share, you'd only need to sell 100,000. And these things are all determined by the institutions, the Wall Street bankers, who say, yeah, well, that's worth that much. That's worth this much. And or I'm going to push this price down because I want this to go up and I want to make profit on the way up, or I'm going to push something up because I want to make profit on the way down, because the stock market has several order types, as we'd like to call it. You've got your buy order, your sell order, your limit orders. Limits are based on buy at this price or sell at this price, nothing above, nothing below. And then you've got the fact that you can loan shares. That's right, you can loan shares that you don't own for a portion of interest and sell shares you don't own. This is the process that we call short selling. So, in short selling, you believe that the price of Apple is going to go down, right? So you loan the shares of Apple at $100, and when Apple goes back down to $95, you buy back those shares at a lower price. By buying back those shares at a lower price, you now have locked in that profit, and you just pay whatever little bit of interest you had for loaning those shares for that period of time. You have made up to $5 worth of profit, give or take, plus or minus your interest that you had to pay. You've made $5 of profit on a stock you don't own. And the short selling is not something that, you have your average investor who can buy and sell, and then you have the ability to short. And shorting is also used by these hedge funds because they can sell something they don't own. They can also create what's called selling pressure. Remember that law of supply and demand. We'll get that supply and demand isn't really there because the computer is doing all the trading and someone's determining where they want the value to be. Well, they can create selling pressure, and law of supply and demand says if there's a larger supply, the price must go down, right? If they keep selling and selling and selling, the price has to go down because there aren't enough people buying to push the price up. And in this way, it's possible for a company or a hedge fund to push down the price of a stock to a certain amount. Let's say that a company let's say an institution looked at your lemonade company and believed that it was going to go bankrupt, for example. It doesn't even have to be going bankrupt, but let's say that they look at your lemonade company and say, that's not going to succeed. So what they do is when your stock is at $10, they start short selling on your stock. The short sell is basically sell into the market, and by doing so, your price goes down. Eventually, if they can continue short selling over and over and over and the price keeps going down, when it comes time for your company to raise money because you need money, when let's say your company is going to need the money to be able to expand to the West Coast or the East Coast. This lemonade company needs to expand and you need to get more factories and more distribution centers. Now that your price is so low, you're going to have to sell more and more shares, and after a certain point that no longer becomes feasible, because the more shares that you sell, the lower the price of your shares goes further. After a certain point, it would be more feasible for your company to go bankrupt. When your company goes bankrupt, that is when you are bankruptcy can go one of two ways. You either restructure and say, hey, these are my loans and I have debt and I need to pay these debts and this is what I'm going to pay you for now, and I'll work out a payment plan as we get this debt paid off over time, or your company just goes under and that's it. You can't do anything because your company doesn't have the money to operate. And if your company goes bankrupt and those shares are shorted and your company becomes delisted and your shares are no longer traded, whoever has shorts in your company doesn't have to close out those shorts. But what happens, interestingly enough, is that they have a lot of money that's sitting there as unrealized gains that they can borrow against. So now they don't technically have to close out those shorts and realize the gains, because that would be a taxable event. And you can't obviously buy back the shares of a company that's no longer on the exchange, right? So they would actually gain value without being subject to taxes, which is what was found out by many retail investors during the GameStop and AMC debacle. The fact that you have predatory short sellers who can push the price down whenever they feel like it, and you have companies that will go under just because somebody else felt it was good to push their price down and get some tax-free money off the table. Let's take a step back and do a quick recap. You've got a company. The company can either sell stocks or bonds to raise money, or sell ownership to a private investor, and the private investor owns a certain portion of that company. Bonds being promised to pay back, stocks being public offering is offering a certain percentage of ownership of the company to the public to raise a certain amount of money. In doing so, this allows the Wall Street banks to determine the value of your company, and they also now have the ability to sell out ownership of your company on the exchange, because you're not going to do it yourself. You're not allowed to do it yourself, really. And what this also does is it pushes your quote-unquote company valuation out there, and they determine what your prices are, because you have hedge funds and banks who literally have more money than God, and they are capable of performing so many transactions that they can determine the price that they want your stock to go to based on what they believe it's worth. The average retail or individual investor does not have enough money to counteract the amount of transactions that this big money has. Therefore, they're just along for the ride, and if they buy something that the big money wants to go up, they sell high, they sell at a profit. If they buy something that the big money wants to go down, or believes will go down, or the big money sees that this company is going to go bankrupt and wants to get out and sells all their shares, now you're stuck holding a bag, and you are now the funder of these hedge funds, because first of all, these hedge funds are holding your 401ks, whether it be BlackRock, Vanguard, State Street, and they are literally using your money and or the money of the many rich people around them who invest in their hedge funds to manipulate the market and move the prices as they see fit. That is how the stock market really works. So next time you go and buy a stock, remember that you're not in control. We'll go over the laws of supply and demand a little bit later, but I want you to understand that everything done in the market all comes back to that crafty bucket maker. Because at the end of the day, because he controls who's able to get the water from the river, the resources, because he's the one with the only right to give out the money, these banks determine the value of a company, whether this company has a value of $10 million or $50. And because they can determine that valuation, they can also determine whether or not a company even has a chance to go public on the stock exchange. That's right, if you cannot find an underwriter for your company, if you cannot, even if your company is the best idea since sliced bread, if you cannot find somebody to push your company public on the market, you lose out on the avenue of having lots of money being raised to run your company, and therefore your growth options are limited. Over the past several years, I've been messing around in the market, learning how the market works, and to say that the market is unfair is an understatement. The bucket maker controls everything, even the economy as you know it. Stop, think, and understand.